Let's get to the cost cuts in the first instance. $4.5 billion by 2022. You said you want to pull back from rates and capital and leverage markets. Where are those cost cuts going to come from? Where's the majority of the cuts to come from?
Yeah, thanks, Manus. When you look at the cost program we've announced today, I think we're announcing a fairly significant restructuring of our non-ring-fenced bank here in the UK and Europe. We said we're going to take 25% of the cost structure out of that business. In the US, we're repositioning our branch network over there and our markets business. We're shutting about 30% of the branches. We're taking out 10 to 15% of the costs. We're simplifying our group structure. We've got an overly complex group structure that we're simplifying with a loss of some group central costs. And I think we, along with every bank, is subject to the ongoing process of digitisation and automation of our business, which will have an impact on back and middle office jobs in the next 3 years.
Ewan, great to speak to you today. The cutting back in US and Europe and sort of reallocating freed up resources to Asia and the Middle East. When it comes to Asia, are you concerned about concentrating more resources and capital there, given challenges like US-China trade tensions, the Hong Kong protests, and of course coronavirus, which we'll talk about more in a moment?
Not at all. I mean, we think Asia continues to be a fantastic secular growth opportunity for us. We're uniquely positioned amongst the international banks there. We've continued to show excellent financial results. We're very happy to have the franchise we do in Asia, and we would like to continue to invest there.
Ewan, can we pick up a little bit? You've set a target, return on equity target of 10 to 22% through to 2022. Can I ask you the basis of that? Is that assuming a V-shaped recovery from coronavirus and a return to normalcy in Hong Kong, the basis of that and the risks associated with that target?
Yeah, when you look at the target, it's based on very modest revenue growth assumptions. We tend to use consensus economic forecasts to underpin our targets. So a combination of some revenue growth, a decent amount of cost reduction. Look, on the coronavirus, it's obviously evolving. There's a big call on how long it takes for the virus to be contained. At the moment, as you can see in our fourth quarter results, we had a very resilient performance in Hong Kong. Profits were up 3% on the year before. But overall, we're continuing to actively monitor the impact of the coronavirus. I do think we're going to have to take some additional provisions this quarter as a result of that, but very much a call on how long does the virus continue for.
Yeah, so on that, you've just said you might need to take additional provisions this quarter for that. If I refer to the statement, you've said that longer term it's also possible that HSBC may see revenue reductions from lower lending and transaction volumes and further credit losses stemming from disruption to customer supply chains. I understand you're still monitoring the situation, but if that scenario plays out longer term, what sort of contingency plans will you be putting in place?
Look, I think you need to keep this in context. Asian business made pre-tax profits last year of just over $12 billion. We're obviously doing all of the sensible contingency planning that we need to do at the moment, very focused on making sure that our colleagues are well looked after, making sure that our customers are supported through this period. But we've got all of the sensible contingency planning that we should have.
Ewan, can you give us any indication of the slowdown in lending, the reaction in China and Hong Kong in this first month of 2020? Make coronavirus come alive in terms of the actual reality for the business, for the market.
Yeah, so I mean, when you look at across our businesses, we've had to put in a lot of contingency planning around some of our operational centres. So a lot of our colleagues are able to work at home rather than going into some of our ops centres. Where for our customers, when you look at the actual January numbers, they continue to be robust. But I think we are seeing some customers obviously struggling at the moment, particularly those dependent in the retailing sector, some of the real estate sectors, anything that's dependent on tourism into Hong Kong. but so far the credit metrics continue to be pretty robust.
Ewan, can we circle back to the job losses that we talked about, cutting as many as 35,000 jobs over 3 years? What guidance can you give to investors, but also to your staff, as to when those job cuts might bottom out? Could those numbers go far below 200,000 once the restructuring is complete?
Look, I think it's not a target for us, yeah, but we do want to be honest and transparent with our employees. We do think around 200,000 is likely to be the headcount number where the bank will be in about 3 years' time. I think on the individual programs and the individual impacts on our employees, we'll talk to our employees first before we'll go public on those.
Ewan, the other big issue for the market to grapple with this morning is stepping back from the share buyback. Can you explain and justify the logic for that?
Yeah, we do think as we go through this period of restructuring over the next 3 years, given some of the economic uncertainty we've been talking about on the call today, given the impact of, and still the uncertainty around the impact of Basel III reform, that it's right and appropriate that we continue to have very high capital buffers during this period. So we have announced today that we're suspending our buyback program for 2 years. What you see with our financials is by the time we get out to 2022, we're targeting a return on tangible equity of 10 to 12%. That's substantially higher than where it was last year at 8.4. When we get back to that sort of run rate in returns, I think we can very comfortably look to restore the buyback program.
Yeah, so the assumption at the moment is that that will be restored in 2022. How much of a priority is it for you to definitely restore that share buyback in 2022? What could put that plan at risk?
Look, for me personally, it's very important. Our investors care about how we manage our capital. We pay out a significant portion of our dividend every year by way of scrip, around 25%. And it's important to investors that we're committing to neutralise that. So as and when we can, we will.
Why has Mr. Quinn not been appointed full-time CEO? Why is the bank telling us that you need another 6 to 12 months before they can make up their mind? What's the prevarication? Yeah.
Look, it's obviously an issue for the board. I think the board's been very clear that they're running a process that they expect it to take 6 to 12 months. Equally, Noel and I have been very clear that there is action that we need to take ahead of that. And I think what you see today is us taking necessary action. We're restructuring underperforming businesses in the US and Europe. We're cutting costs. We're simplifying the organisation. And we're getting back to a place in 3 years' time where we think the bank should be in terms of returns. And those actions, I think, need to be done independently of the CEO process.
Right, so you're taking those actions now, and you say they're happening independently of the CEO process. Does that mean if there is another CEO in place in 6 months' time, that investors can rest assured this strategy will remain the same?
Yeah, look, I think everything that we're announcing today is no regrets. I think anyone looking at this will say, look, these are very sensible actions for the bank to be taking, and actually very necessary actions given the economic outlook that we're facing.
One of the most, I suppose, interesting comments that I read from one of your shareholders, which was, we wrote it up yesterday, this is from Capitulum Asset Management. The currency strategy is in no man's land. You've laid out a very clear, I think, line on what the strategy is, so that defies that. HSBC should stop being so prudent, take risk and expand, or otherwise shrink and shrink fast. What do you say to that?
Look, I think we are doing that in this plan. We are shrinking in areas where we think that we have clear underperformance and a lack of long-term sustainable competitive advantage. Equally, in today's plan, what you see is significant investment in those parts of the business where we do think we have competitive advantage and we can grow. So I think we're absolutely doing both of those things.
Yeah, it definitely was an interesting comment from one of the shareholders and sort of laid the options for HSBC, Ewan, as fairly binary. What you're saying is that you're kind of balancing those two sides of the coin. Are you happy that you're getting the balance right from those two binary options?
We think this is the right thing for the bank to do, the right plan for now. We are looking to invest $100 billion of risk-weighted assets, around $14 to $15 billion of capital in the next 3 years in parts of the business that are performing well, particularly Asia. So we do think this is the right balance. It's coupled with a very substantive cost reduction program, coupled with organisational simplification to allow us to speed up the pace of execution. We think it's a great plan.
You just pick up on the risk-weighted assets. I could say to you probably you're at that moment of leaning into not bad asset price markets and a hunger for yield. The risk-weighted assets you're going to sell, just a little bit more complexion on them before we go.
Yeah, well, unsurprisingly, it's in parts of the business, the markets business in global banking and markets. I think we are intending to exit a lot of domestically focused customers in Europe and the US on the global banking side. And we're also going to exit international customers that are not producing acceptable returns today. So I think we're going to be quite surgical and ruthless in terms of targeting those parts of the business where we're not generating acceptable returns. We're going to take those risk-weighted assets and reinvest them in parts of the business where we can see much better returns.
Yeah, just very finally, Ewan, on the US business, just characterise for us what that's going to look like. We know the numbers, but what exactly are you trying to achieve?
Look, two things. I think on the retail side, we're getting back to where we think we have core competitive advantages in servicing the diaspora population in the US and international customers. So what you see is a 30% reduction in the branch network, predominantly focused on the East Coast and building branch presence on the West Coast. And secondly, on the global market side, reducing our presence in the US quite materially and looking to concentrate more of that business into London.